Okay, 5, 4, 3, 2, 1. Good morning and welcome to this week's edition of the Daily Energy Markets Podcast, Month in Review, Month Outlook. And with today, we're delighted to once again be joined by our anchor host, Christoph Ruhl, the well-known economist and analyst in the energy markets, now senior research scholar at the Center on Global Energy Policy at Columbia University. And we're delighted to be joined this week for the first time, Yan Liang Miao, Chief Strategist and Executive Head of Research Department at China International Capital Corp, which is a very large investment banking operation in China, with leading on so many levels, the biggest IPOs and all sorts of excellent work. And Yang Liang heads up the research department, which has hundreds of analysts pumping out reports on every industry and great detail. So Yang Liang and Christoph, thank you for joining us today on the Month in Review.
Thank you.
Let's kick off with as we do with the sort of most immediate news, the most imminent sort of reality, and that is OPEC Plus decision yesterday, Christoph, to once again continue with their accelerated supply increase. And this time they've even added a little bit more. So in August, instead of 411,000 barrels, which they've been doing the last few months of increases, they're now going to ramp that up to 500 plus thousand barrels from August. Your thoughts on that decision and this whole program of OPEC supply increases that have been ongoing now for 3 months?
I think it is in a way not a big surprise. It's more of the same, because really what matters here is the decision to accelerate and to get rid of the voluntary production cut of 2.2 million barrels by September. And so the question is, was it a surprise that they cut by more than expected? Probably not, because it was telegraphed before. But even if it was, it is a small increment, and so it cannot have been a very big surprise. And it's part, as we discussed numerous times, of the strategy when things are aligned now, of A, to maintain discipline in their own organization, and the keyword here was the dispute with Kazakhstan. Of B, preparing for all sorts of supply disruptions. The keyword here was, we've seen how oil markets remained pretty stable during the bombardment of Iran. And C, most importantly, and still sort of somewhat underappreciated by the market, the question of what happens when global oil demand starts plateauing and slowing down and eventually peaking. If that happens within the next few years, you do want, as a producing association, sit in the starting block with full capacity utilization and not with 5, 6 million barrels of spare capacity.
And do you identify anything over that period of time that OPEC Plus, I mean, any of those reasons that you have highlighted there that is driving this decision? I mean, the idea that some reporting is the biggest producers, Saudi Arabia, wanting to punish the other producers who are not complying with the cuts, or I mean, because it does feel like it's gone against the expectation where demand is.
Yes, I do see one, but it's not punishing other producers. If you are a cartel and you do punish other producers by increasing production, you're shooting yourself in the foot to some extent. That's an expensive punishment. I do think that the prime reason is the long-term expectation of excess supply in the market. And when you listen to the arguments come out of these deliberations very often, it is the hope that, number one, supply will react outside OPEC. So in particular, with lower prices, shale supply will decline or stagnate. And number two, that global demand will remain strong enough, and that those who are seeing gloom and doom and a peak of oil and demand in China are wrong, so that global demand will pick up the slack. On the first one, on the supply side, I think there are systematic mistakes on both, by the way. But on the supply side, and then I will leave it to Liang to talk about the Chinese demand. But on the supply side, I think people underestimate the degree of flexibility of oil production in general and of the shale patch in particular, because we have a very long history of price fluctuations and time and again production costs follow prices very closely with a lag, but it's a lag between somewhere 12 and 24 months. And it's the shortest, where the lag is shortest in onshore production in the US because that's where the infrastructure is best. So what you will see most likely is prices coming down and then steel prices, rig rates, rental rates, wage costs, all of that also coming down. And the shale response in terms of volumes being very moderate over time.
Well, let's bring in Yang Liang on that point, because the critical part, Yang Liang, on all of this OPEC plus decision making to increase supply is where is demand at in China? It's been the biggest question of the first half of this year. A lot of the sort of general reporting and research, market research, has indicated China weakness from an economic growth point of view, and with that energy demand point of view. How has the first half been, the China's last quarter? Is OPEC increasing supply into a weak China demand? How has the first half of this year gone for China, particularly given the stimulus efforts that they've made?
Yes. Well, first of all, uh, thank you for bringing me to this podcast. I'm
It's an
very
honor to
glad,
have you.
yeah,
Absolutely.
together with my old and good friend Christoph. On China demand, oil demand, and Chinese economy, I think the first half has proven, to be very resilient, despite several challenges, right? We have seen a few challenges, including the tariff shock, and then there's other global uncertainty. But as you mentioned, I think the turning point is really from last year, from the stimulus plan carried out since September last year. Now, I think, if we think about the demand related to the Chinese economy, the number one, of course, is really, the cyclical activity, the transportation. So last year, China's apparent consumption is 750 million tons. That's translated to about 15 million barrels per day. I
In
think this year,
2024.
2025, that's 2024, yeah. This year, is probably similar, probably like a slight increase, like around 1% of the apparent oil consumption demand. Um, so on this apparent consumption demand, there's two parts. Slightly over half of it is on transportation, gasoline, refined oil. Another half, like slightly less than half, is for chemical product, feedstock for chemical product.
So half of the
I
15
see,
million is for mobility transport, and half of the 15 million
yeah,
barrels a day is deployed for petrochemicals, Fox
exactly,
feedstock.
exactly, yes. I think on this, going forward, I think, we have to watch a few, key factor. On cyclical factor is really, how, the economic activity, whether people are moving, they're traveling, uh, take air flights. I think that's clearly, I think, is rebounding. And then, but uh, we have to notice that there's a huge structural shift in the Chinese economy, namely the new electrical vehicles. They represented a ever larger share of the Chinese transportation tools. This year, last year, like 45% of new sales of cars is in EVs. This year will be 55%. And then 5 years from this year will be 75%. So the new EVs, they're taking an increasingly large share of, of
It,
the transportation
in
method.
looking, if I might just, in looking to that point, I just wanted to get your precise opinion on it. The
Hmm.
stimulus program that the Chinese government started in the fourth quarter and continued through into the first quarter, uh, a lot of it seemed to be small, bite-sized stimulus rather than any big bazooka, as we might say in the English language, like any large, massive, like we saw in the US during the COVID period. They had some massive stimulus
Yeah.
programs. They even sent checks to people directly in their homes. Uh, China's stimulus on this occasion seems to have been bite-sized and incremental, and so its
Yeah.
impact less. Is that a fair assessment, or how do you see it?
Yeah, I see it, there's always two balancing forces here. One is, the need to stimulate, to do counter-cyclical stimulus. The other is to guard against moral hazard. In China's case, is really, the local government. So local government in the past, they have borrowed a lot. They have relied on land financing. They sell land, and then for two commercial developers. Now those developers, they build real estate and then they sell to consumers, or even to commercial real estate. But that model has come to the past. So I think now here is it's really a tug of war between fiscal discipline and then the need to stimulate. But I do think the balance has shifted now to be more stimulus. Probably we also need to be, uh, patient on that, because China has taken a different approach from helicopter money, right? I mean, you get helicopter money to people, and people can go and spend the check. Now China they do more on not traditional way. Traditional way is like infrastructure, real estate. Now I think we increasingly focus on soft infrastructure, like or to update the old neighborhood, city infrastructure, all this. And then I think recently the Chinese government has just announced that they're going to give financial support to every new birth, from 0 to 3 year old. So in all this area, it takes some time. Some of the big things they announced, like debt swap program, that's very fast to ease the financing constraint of local government. But some other area, I think you see program one by one, in the pipeline. So yes, I think it's not a helicopter money bazooka in that sense, but in terms of policy shift, no doubt.
Okay.
Can I
Christoph,
ask
when we
something?
think,
Can I ask something
sorry, go
on
ahead.
this context? I was always wondering. So China, of course, is also one of the countries which used to have big bazooka fiscal support in crisis times, mostly concentrated on stimulus packages for industry. And industry is very energy intensive, including oil intensive. You think of cement and plastics and all of this. And the question I'm having is, China always sort of fell short of using stimulus programs to expand more in a decentralized service sector. If that is now gradually changing by hook or crook and by tariffs and by design, and big stimulus becomes more targeted to services, in particular financial services and microchips and artificial intelligence and internet services, and then also in addition to consumers rather than to just big infrastructure projects, will that result in the same sides of a stimulus package being less energy and oil intensive, or is it not so clear cut?
Well, I think that's a link to this peak oil debate. Maybe in terms of a share of oil out of global source of energy, you can see a share in terms of percentage, maybe peak, but even in terms of the absolute amount, I don't think it's there, because even if you stimulate going to services, whether it's data services, AI services, those things the consumer, even I think in terms of absolute amount of energy, consume even more energy. So that energy can come from new sources of energy, but it also can come from traditional you know uh, carbon and other source of energy. So in that sense, I do see that maybe the new stimulus different from the older stimulus is probably more services, more consumption oriented, but it doesn't necessarily translate into less absolute demand for oil. Maybe more demand is in the new energy, but even in this new energy, there's some of them they consume a lot of electricity, and some electricity is generated by the traditional source of fuel. So I
Coal and
see,
gas and other
yeah,
things.
I
Let's
see
just
that
also
it's
go
not a
into
clear cut sense
Christoph.
there.
Christoph, just looking at the other big events of the last month, the last quarter, what stands out to you? Of course, we started the second quarter with the big tariff announcements that were suspended. The reciprocal tariffs, they're now back in the front page of headlines again because that's about to expire. What do you reflect upon, Christoph, in the second quarter that is noteworthy to move forward?
Well, it's a curious mix emerging there from in terms of economic policy in the US, right? You would expect tariffs to have a negative effect on global growth rates, at least slow down global growth rates, even if it's not so dramatic. It's never good from coming out of the last 20 years we had when one tries to reverse the needle on that. On the other hand, you have an extremely expansive fiscal stimulus package, if you want, and the tax reform which happens there, which was just pushed passed through Congress and signed on Friday, is going to have a hugely expansionary effect, also probably going in the direction of inflation. And so I do think that from various angles now, when you only look at the US, we have the rapid rise projected in national debt. We have pressure on the inflationary side from not from oil for once, but from the tariffs and from the fiscal policy which they implement. And we have a detrimental effect on the global integration and global growth eventually, which will reflect on the US as well. That doesn't look too good for the medium and long-term growth prospects. Now, with Trump being sort of a very impulsive policymaker, I think, and with people expecting the taco reaction again, that he always backs down in the end, we will see, I think, continued volatility starting, even if there's a break now in volatility, starting before the midterm elections, when he will have to make good for some of the disappointed MAGA base, which are people who no longer get Social Security or mega or health insurance, and where he will probably see the first criticisms from the entrepreneurial camp and probably even slow down in growth and investment rates. And the measure for all of this, I think, for someone of Trump's nature and his cabinet, will be the US stock market. So once you see that dipping, and that is going to happen at some point, then you will see an flurry of activities again to rectify that.
And that seems to be the equity
But
markets.
it's going more into a morass of contradictory policies rather than reflecting a clean strategy.
Yan Liang, what about from a China perspective? We saw in the second quarter one of the biggest stories and economic impacts was the China-US trade war when they both went above 100% tariffs. They've pulled back from that, but again, that's still an interim situation. How is China performing, sustaining its economic growth through this tariff trade face-off with the US?
Yeah. Yeah, I mean, even when the very exorbitant high tariff rate came out to China, I always said, tariff is a blessing in disguise, because it will help China make the right decision. I mean, the decision is always, when China's economy needs rebalancing, we need rebalancing from investment to more consumption. So I think, China is not afraid of tariff. If anything, tariff will, only make the stimulus more urgent. Okay, that's originally how I view tariff. Now we see a couple rounds of negotiations. Tariff has now come down to more normal level. There I see, a few things stand out. Number one, China's manufacturing resilience has been proven again, whether it's US reliance on Chinese goods or China can re-export through other countries, or Chinese manufacturers, diversify its own supply chain to other countries. That's number one. Number two, in this several rounds of confrontation, you can clearly see that, I mean, to me, I think, China has proved it has more leverage than many people thought. You see news come out in the recent week that US actually has loosened its export controls on China. So in that way, I think it's actually good news for the Chinese economy. Taking all this together, I think, in terms of the macro number, uh, whether it's export number, import number, and then linked to the PMI, I think for the first half of the year, you will be comfortable to achieve a 5% growth because some part is a low base from last year. So last year is a huge fiscal tightening, but then shifted towards the second half of the last year, it become a fiscal easing. So I'm not worried about the economic growth rate. But I think the longer term is really how China engineer a rebalancing and how we achieve a soft landing. Yeah.
Christoph, if we might just sort of look forward now, obviously a lot of these trend issues that we've seen in the first half of the year, and most, I suppose, notably the Trump disruption, really, for instance, coming into office in January, and since that day, it's just been one long series of tumultuous announcements and policy shifts. Can we look to the second half of the year having kind of absorbed the kind of the Trump shock has been bedded in now into the markets, even though we still have to get through this next week, even the tariffs have to be actually finalized and announced. But how do you see the second half of the big Trump disruption of the first half? Will the world be more comfortable or more sort of stable because they're just growing to how to deal with it?
So that's something nobody can predict in this triangle between geopolitics and global economy and
Mm.
energy. But first of all, I strongly agree with what Liang had said. These tariffs, China is strong enough to withstand them. I also agree it might be a blessing in disguise to push the structural adjustment, which has to happen anyway. It's a bit different, perhaps, for other countries, including the US, because the US is more dependent on China in these trade relations than the other way around. And Europe is sort of caught in the middle. And
And Japan seems to be getting hit now. At least the
Japan,
reporting
yes.
would
So all
indicate.
these countries which might become the battleground of the future tariff wars, with both China trying to export there and the US trying to discipline them because they can't discipline China. So there's a bit of a gray zone which I see coming into focus over the next weeks and months as tariff deadlines will get broken and as the US has learned probably to not touch China too hard. Another issue which I think we should expect some more calm and now in prevailing in the Middle East, even though in some instances some people may call it the calm of a graveyard. No? But another issue which is likely to come back is Russia and the Ukrainian war, because the
Which
Russian
is really
economy
heating up
is,
in the last few days.
yeah, well, there are several good things going on. First of all, if low oil prices are here to stay because of OPEC policy and the Middle Eastern situation, and if Trump has a strong link to these oil-producing countries in the Middle East, then Russia's position is suffering, its financial position. Secondly, the Russian economy is now a complete war economy, but it is it's creaking. It's becoming sort of less sustainable. They have used up a huge amount of their reserves. The interest rates are sky high and will have to remain that way in order to avoid inflation and problems in the banking system. And thirdly, by all indication, the Russian president is determined to continue that war, and Trump is slowly waking up to the fact that he cannot full deliver on his promise of making him stop. And if he then turns around, and that's of course the decisive factor, and implements very tight sanctions on Russia, then we will have some degree of instability emanating from Russia over Eastern Europe and countries in that region. And it's everybody's guess. Again, I'm not a political scientist, so how China would react to that. But this is the geographic region where we should politically expect tensions, and Europe, Japan, the smaller countries which depend on exports to China and to the US and trade with China and the US, that's where we should expect some economic trouble to arise, perhaps.
We did
And the
see
biggest
interest.
unknown to me is simply the net effect of this huge, big, beautiful bill in the US. Is it really just being inflationary puff, or is it? It has elements which will trigger more growth in the US. No? So the US is a strong economy, is an independent economy. Can it pull off a continuation of these past high growth rates for the time of his presidency, at least?
Well, it's certainly the concerns that we saw in the bond markets in early April when the tariffs, the Liberation Day, I think it was called, all these big names, but ultimately when the big tariffs were announced, the bond markets went very crazy and were very under great distress. And I think that that is some sort of cuckoo in the coal mine, and whether we'll see the bond markets get under duress again as a result of both the tariffs coming and the big beautiful bill bringing extra large amounts of new debt to the United States sovereign debt. Yang, I wanted to get your thoughts because one of the big questions about the outlook for the second half of the year is China's energy security. Even if China's demand or consumption, as you mentioned, is consistent around 15 million barrels a day, half for mobility, half for petrochemical industry. But what about for energy security purposes? China might actually continue to buy more oil to put into, for example, inventories. How do you see China's energy security strategy evolving into the second half of 2025?
Yeah, well, when I mentioned this 50 million barrel per day, I call it, apparent consumption. That of course doesn't count inventory, demand. Um, I do think, in this new world that, many countries, they do have an incentive to build buffers, whether it's a energy buffer or it's a chemical buffer or a precious metal buffer, all this. So, but I'm not, I'm not an expert in that area, digging into, what's the right amount of inventory. But I want what to leave you is, you think about in the longer run, what's really driving China's oil demand is other than, gasoline, travel, chemical product. There's a third component is, the Chinese economy is becoming more efficient. For the past 3 years, every year, the unit energy consumption of the GDP is actually declining by almost 3% year after year. So it's still become, more energy efficient. Part of it is become, even in this industrial production process to become efficient. The other is, of course, is linked to more of the GDP is now generated from, the new energy sector. So those doesn't consume the traditional, the less traditional energy focused. So from that stance, I think, probably, we think about, maybe the in the past, China has always been the largest, demander for oil. But in the future, I
The
think
world's largest
it's
oil
going to be
importer.
importer. Yeah, I think in the future will be slightly different. It's not. It doesn't mean that come down, but it actually means the component will be different.
I think this is a very, very important point. When I was always in these past sessions we had here, sort of insisting that or predicting that at some point, everything else equal, in the next few years, global oil demand will peak. Sean, as we discussed before, it was always based on the observation that the efficiency with which oil is used globally continues to improve like in a straight line. And if you just extrapolate what has happened the last 35 years, you get peak demand in 2029. And I think China is actually right up front in this development because of efficiency improvements in energy generally, but also in oil, and also because of the now accelerating shift from a very high share of the industrial sector to more consumption and other activities. And I think in that sense, China sort of just completely complements or even leads the rest in the world in the way they have these efficiency improvements, which will inescapably lead to a situation where oil demand stops growing at the rates we have seen in the past.
If we might just, as we wrap up, go to what could surprise the markets the most in the second half. Yan Liang, what do you think could surprise the markets the most about China's external balance and commodity imports?
Huh. I would think, um, tariff may actually, normally people think a tariff would reduce exports from China, but because of this, the way tariff has been imposed and then lifted, it may actually boost Chinese export. Yeah, for the time being. Yeah.
But isn't that the problem? I mean, that you're getting in a lot of trouble now because a lot of countries are reacting to sort of dumping of steel and dumping of EVs, and given the U.S. market, that a lot of
Yeah,
other countries are
I
reacting
think it's the
against.
problem. The problem is like it's a shock, right? You can call it a type of shock, but it's more a demand shock, also a a confidence shock. It's more a confidence shock. So that's a shock is not originated from China. China is passively accepting the shock, and then that shock is whole global manufacturing system. It's a shock, but it's not of China's origin. Yeah.
And in that, through the second half, you're confident that the China demand will continue in and around 15 million barrels a day.
Yeah, I'm confident on that. I think, if anything, I think, probably from, trying to get out of the low inflation zone, China probably need to push down the gas pedal even more heavily in the second half of the year.
Christoph, you're kind of surprised what might surprise markets in the coming months.
Maybe the Trump's winning streak continues. So far, I mean, you have to admit whatever he touched in the first few months, from his perspective, worked out pretty well in the end. And he seems to have the momentum and some of the biggest obstacles out of the way.
I mean, it's not long ago we
Maybe,
were talking, all the reporting was about the idea that US would be going into recession on the back of all of these
yeah,
tariffs.
so this would translate into no recession, no detrimental immediate impact from tariffs, no super spike in inflation. All the things people predict to happen will not happen, and him winning the midterms. And uh,
What
that's
about the outlook for OPEC supply plus? They could continue to accelerate these increases because there's apparently another one in September because if they've still got a
Well, you do the
500,000.
numbers. We do the numbers. We had about 6.5 million spare capacity. That was the result of three different cuts. The first one of 2.2 is now being unwound by September, so that brings us to 4.3 spare capacity, más o menos. The second one is 1.6, will probably be unwound also ahead of schedule. That brings you then to, I don't know, 3.7 or something. And then you had the original cut of 2 million, and that would bring you right back into the normal range of 1.5, 2 million, which is then not really, it's spare capacity, which is always there in order to have redundancy in the system. And we are back to normal. And I would expect this to continue at a fast pace.
Well, we're going to have to wrap it up there. Brent crude oil, of course, started out the year at around $80, a little over $80 a barrel. We saw in mid-January, $82 was the high for the first half of the year, and then it declined now, despite the spike during the Israel-Iran war. It went up $10, but has come back and now trading at 67.50. So as a whole, it averaged $70 in the first half. It seems getting that same number in the second half would be an achievement, but ultimately more optimism about economic outlook. As Christoph said, Trump somehow continues to defy gravity and have what he would consider successes. And China, as Yang indicated, from a demand point of view, its economic health and resilience is don't bet against it. It's quite resourceful and probably, by the sounds of things, is going to hit its 5% target again this year in terms of GDP growth. Would that be a sign off, Yang, that 5% growth will be achieved?
Yeah, I think, in terms of real GDP, yes. I think the problem is not about the real GDP, it's about nominal GDP. I think that's the challenge where challenge lies.
Okay, interesting.
Yeah.
Well, we'll wrap it up there. Christoph Ruhl sitting today in the United Kingdom in Europe. Really great to have you as always anchoring the first Sunday review. And as you mentioned at the top, this is our last one of the season because, of course, the season ends next week. And so we have our last week coming up, lots to cover in the last week. And then we go on the summer recess and back on September 1st. for the first show of the season. So, Christoph, thank you so much for all of your engagement this season. And Yan Liang Miao, Chief Strategist and Executive Head of Research Department of the China International Capital Corps. I hope this is the first of many conversations that we can have together. We have our annual forum in person in the UAE in October, and it will be lovely to have you join us there and have this as an in-person conversation. But until the next time, thank you, Lian Liang, for joining us, and thank you, Christoph.
Thank you. The pleasure is mine. Thank you.
Thank you. Have a good Sunday, everyone.
Thank you. Bye.
All the best. Have a great day, guys.